Hi everyone, welcome to my channel Business and Supply Chain Academy. In this video we are going to explain liquidity ratios. Before explaining liquidity ratios, we have to define what ratio analysis. Ratio analysis is quantitative methodology of gaining insight into companies' liquidity, operational efficiency and profitability by studying financial statements such as income statement, balance sheet and statement of cash flow. Ratio analysis include different categories. Number one, ratio analysis. Include different categories. Number one, liquidity ratio. Number two, solvency ratios. Number three, profitability ratios. Number four, efficiency ratios. Number five, coverage ratios. Regarding liquidity ratio, it measures a company's ability to pay off its short-term debts as they come due using the company current or quick assets. Solvency ratio called financial leverage ratios. Solvency ratios compare the company's debt level with its assets, equity and earning to evaluate the likelihood of the company staying afloat over the long haul by paying off its long-term debt as well as interest on its debt. Profitability ratio include how well a company can generate profit from its operations. Efficiency ratio called activity ratio evaluate how efficiently company uses its assets and liabilities to generate sales and maximize profit. Coverage ratio measure the company's ability to make interest payment and other obligations associated with its debts. Next, we will focus on liquidity ratios and how we can calculate them. Now we will explain the liquidity ratio. The main definition of liquidity ratio shows the company's ability to pay its short-term obligations. In order to analyze liquidity ratio, we have to check two main ratios. Number one, called current ratio, Number 2, called quick ratio. The main difference between current ratio and the quick ratio is quick ratio remove inventory from calculation because it needs time to be liquidated into cash. So the quick ratio give much more better image about the company's ability to pay its short-term obligations. Now we'll explain how we can calculate current ratio and quick ratio. Current ratio equal current assets divided by current liabilities, while quick ratio equal current assets minus inventory divided by current liabilities. As we know that balance sheet and the important financial statement include assets, liabilities, and owner's equity. Under the section of assets include long-term assets and current assets. Under liabilities include long-term liabilities and current liabilities. In liquidity ratio, we are focusing on current assets and current liabilities. How the company can utilize their current assets in order to pay its short-term obligation represented in current liabilities. Regarding the current assets for all company can be converted to cash within 1 year. Current assets include cash, include cash equivalent, include account receivable, include inventory, include marketable securities. Regarding the current liabilities are the company's short-term financial obligations that are due within 1 year or within normal operating cycle. It includes accounts payable, notes payable, dividend payable, any short-term obligations that can be exist in the section of current liabilities. Example on calculations. Suppose that we have inventory equal $15,000. Current assets equal $60,000. Current liabilities equal $40,000. We need to calculate current assets, current ratio, and quick ratio. The current ratio equal current assets divided by current liabilities, in this case equal 1.5, while quick ratio equal 60,000 minus 15 over or divide by 40,000 equal 1.125. The current ratio less than 1 is an indicator that a company might not be able to pay its short-term debt. On the other hand, a current ratio greater than 1 can also be a sign that the company has too much unsold inventory. That's why, as we talked before, quick ratio is much more accurate than current ratio because it removes inventory from its calculation and give better image of the liquidity of the company. So our conclusion as follows: current ratio are not always give a good snap shot of company's liquidity, as they assume that inventory can easily converted into cash. That's why we always focusing on quick ratio, because it's remove inventory from calculation and give much more better image. Thanks so much. Hope you enjoy learning. See you next video.